Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today we're going to look at three specific topics. One really being looking at global storage, specifically on refined products, going through and just kind of doing a quick recap on some key economic drivers, and then wrapping up with the Primary Vision Frac Spread Count and what we think is going to happen for duct counts and where the world kind of sits for U.S. crude. So really here, we're going to really jump in and look at both the ARA, which is the European product storage, and then we're also going to have Singapore. So here you can see the ARA or Europe had some small draws across the board, but again, they still remain at near all-time highs on a seasonally adjusted level. And that's really the key here, is really where are they on a seasonally adjusted basis. And, we're going to focus a little bit more on gasoline in a moment, but just to kind of give you an idea that we got some small draws, but again, gas oil and gasoline are going to remain key for us in terms of getting more oil demand within Europe as some of these stocks start to draw. Now, they kind of go back and forth because, we came off of a 3-month low, I believe, going into West Africa for exports, and it's nice to hear and it's good to see, but again, it's something that we don't think is going to be continuous, just given the problems that still reside across West Africa from a demand level. And then when we turn and look at Singapore, you can see that we had a small draw, but again, the draws should be happening at this point in time, given the seasonality of it, and it really didn't come in light distillate or diesel, which is in this point gasoline, diesel, but it came in residual fuels, which is just going into some secondary refiners because they're trying to find the best, cheapest way to make product. And when we just look at one of the key ARA components, this is the gasoline piece, you can see that, again, it started to dip. We had some more exports of gasoline going into West Africa. We had some additional exports going into LATAM, but again, the demand locally, while it has recovered, Europe is still down anywhere from 20 to 30% on a gasoline level in terms of, where no one's really driving. And that remains a problem across on a global level. And we'll touch on India because that's kind of a key driver for where we see some bright spots as we go into next week. And just looking at overall Europe, Singapore storage, you can see that we're still at those all-time highs. Now, again, we've come down, and when I say all-time highs, I mean on a seasonally adjusted level, because when we look at this, we have to appreciate what's happening seasonally. And we've had we had a drop-off in some Chinese exports, which we'll talk about in a minute for May, even though June's going to be a little different in July. But here you can kind of see where these stocks continue to build and continue to remain, which is really weighing on prices and is really depressing what refiners have the ability to do. And just to look at Asia in a little bit more depth. So this is just a picture looking at China. So we're looking at all of the different boats throughout Asia, but we really want to hone in on that little pretty polygon with the number 47 in it. And that is one where the independent refiners are. And you can see that there's a huge amount of crude just sitting offshore. So Kepler came out with some new data that looks at that as of June 29th, tankers that have been sitting for 15 days or more has gone up by about 41% and is now sitting at a new all-time high of 43 million barrels. So this is something that's going to be a problem as we consider how China is going to purchase going forward. They have a significant amount of crude just sitting offshore, and they have more oil heading their way, specifically in transit, which is going to be problematic. And Brazil just came out with their own numbers. And the reason why we talk about Brazil is because, you have 60% or so of their flow going into China. And, they were down, about 17% month over month on exports. They were down to about 1.3 million, which is a 9-month low, which sounds great, but it's up 29% year over year. So you still have that non-OPEC growth and on the oil side that remains sticky, which is continuing to be problematic when you think about the supply-demand balance that we're really not getting in the market. And that's when we turn to, Chinese exports. So the data came out for May. We knew it was going to be low. We actually thought it was going to be lower. So here you can see the white line is gasoline exports. The blue line is diesel exports. Now, gasoline, they had to backfill. A lot of provinces couldn't refill because there were still shutdowns. And this was April into May. But so far, what we've tracked through June has this completely reversed and right back to the highs, and it's because refiners have remained well above where they should be, given what local demand is. So we're going to see this reversal, which is again going to put additional pressure on those refined products, because we're just seeing, most of these areas, specifically Singapore, Indonesia, India, refinery margins just aren't there. South Korea is another one that it continues to be under pressure, which we'll touch on briefly at the end. Just looking at petchems, there's just no real margin anywhere kind of across that supply chain, which is going to be problematic. Now, India is interesting, and this is something just looking at some key economic indicators that are I think relevant in terms of how are they coming out of lockdown, how are things adjusting, and you see the new cases continue to rise, new active cases continue to rise, but the lockdown index, which is just how much has been shut down, continues to adjust. And we've seen that in the US. After coming out of a lockdown, you really can't go back into this all shut down. Instead, you're going to have to do it in pockets. You're going to have to roll back phases. You're going to have to look at it on a county by county level. And that's what we see here. But the increase in cases is also keeping people from driving extensively, which you can see in the congestion index, where people just aren't driving as much, which is one of the reasons why, as we said yesterday, and we've been kind of harping on, is getting that first 80% back is pretty easy. You're going to get that first surge, people are back out, but closing that remaining 20% is going to be hard. And right now we have India at about 80 to 85% of where they were previous to COVID. And if you just look at jet fuel and all these other things, I just think that delta is going to remain straight through the end of the year. And when we talk about some positive news, yesterday we made mention of the European PMIs, and here you can kind of see them lined up with France back to that growth profile. These are all great, and it's something that is that's going to continue to pull through, because Europe, specifically France and the European area, which is really kind of driven by Germany as well. France and Germany continue to see this resurgence, continue to start to climb back out of the hole that they were in. The problem is going to be, what are their counterparts doing? And Germany has a huge export market, and as we know, their trade partners continue to struggle. So it's going to be hard to see this really get back to where it should, to really kind of see that real expansion. But again, this is still some positive data that's showing some life. And now, as long as they can keep COVID in check, they should be, well positioned to continue to see this little bit of a grind higher. Unfortunately, yesterday, Japan announced that they found 100 new cases in Tokyo, and you can kind of see how well this hides and then kind of can surge again. So you just have to really go after those aggressively and do that tracing. Now, when we look at the U.S. economic data was something similar. Like, we had some positive manufacturing on a PMI level yesterday. We saw some positive moves in new orders. But again, the employment remains the problem, which is where we think there's going to continue to be this overhang, which we'll talk about in a minute. And today we had some factory orders, durable goods, and you can see that even though they were positive, they were still well below where they should be or where they were expected to be. And as you have new unemployment ramping, you have new lockdowns coming, this is going to continue to be an overhang. So we think that, while May was good, June will be good as well, because, we finished out June relatively strong. We had some slowdown in the last week, but not enough to really reflect. The question is now going to be going into July. If this is some sort of trend, which we think it is in terms of where employment's going, you're going to get this overhang that's going to have to price back in to some of this economic data. And that's why when we look at the new manufacturing orders, we look at it on a year-over-year basis to try to get some of that noise out. And you can see, again, we came off hard through May, and June finished off, we were only down about 15%. We think that when the June numbers come out, you're going to see an additional benefit where you're going to probably only be down probably 5%. But then the question is going to be, what is going to happen in July given this renewed resurgence of COVID? And this is something that will be positive in the near term, but will be a wait as we go forward through the end of the year. And when we look at U.S. employment data, this is an interesting view. We've talked about home base and these different adjustments in terms of working hours. And here you're watching people go from temporary laid off to permanent job losses. So the temporary layoffs are going to adjust for two reasons. One, you have some restaurants coming back, some hospitality coming back in general, and you just had some restart and some headcount has to come back from the restart. But you also have people that are now permanently laid off. They have gone from temporary to permanent, and you're starting to see that converge. Now, this is something where we think that temporary layoffs are going to reverse and go higher again as some of these layoffs restart, just because of these lockdowns that are being forced again, or the rollback in phases, and it's just something to consider as we're going forward and trying to price out where is gasoline demand going to go, where is consumer demand going to be. And that's why we look at U.S. permanent job losses versus the S&P 500. This just kind of highlights where the world sits on the S&P 500 and where it should be. Again, we think there's going to be a true up. One doesn't have to go all the way to the other, but there's going to be some sort of correction on both sides as you get some permanent job losses, stabilize here, because the one big thing that we've seen is the continued claims remains over 19 million, and we think that's going to start to creep higher, especially as some of these temporaries become permanent on a layoff basis. So now that we've recapped a lot of the economic data that's come out and really kind of put us in position for what's happening globally, now it's time to turn to the primary vision frac spread count. Now today it came in at 74 for the week, so we're up 4 week over week, which is nice to see. A little bit more activity, but again, it's really not coming from anywhere specific in terms of the large basins, but really in Oklahoma and just one other within Denver. So there's really nothing that's going to really be sustainable, as we've talked about in the past, where we're really going to kind of waffle back and forth between about 70 and 80. And we're expecting about a 4-week average to maintain about 72 to 73 as you get these, one or two coming on, doing some work, and then going back on the sidelines. And here, when we look at, where things are on that 3-month chart, you can see in April, we were back at 215, and it seems like such a long time ago, but here we are at 74. And just to kind of put that in perspective, we're down 700 rigs year over year. So everything has really kind of shifted, and we really don't see too much activity coming back, especially given the current pricing environment. But we have to look at, what are the drilled but uncompleted wells doing? What's the DUC count look like? And that's why when we think about where we were on July 5th, you can see we're at 379 and we're now at 74. And we really don't have the pricing environment to really kind of break us out of that. But at the same time, as we talked about with the rigs coming down 700, we really don't need rigs to come back as quickly, just because there is a certain amount of drilled but uncompleted wells or DUCs that can be worked through. The question is always going to be how many are viable. And that's a question that we're continuously trying to refine and come up with our own way of figuring out, what are the actual DUC counts and where are they viable. And here it gives you kind of a list of where things sit. Now, to understand DUC counts, there's always going to be a natural DUC count, because you need to have the rig keep moving ahead and have the completion crew come up behind it, but you need a certain amount of cushion in between that. So when you think about what is going to hinder some of these completions, you're going to have some of these are just old and they either fell out of zone, had some technical issue, then they'll never see the light of day. Then you have some that were drilled in anticipation of a parent-child well, and then once it didn't work or they lost pressure, that was scrapped, but you still have the wells that were drilled, But really the lion's share is going to be the pricing environment. Some of these wells might be in what quote unquote tier 3, tier 2, where they really don't have the best production and you need a much higher pricing environment. And at the same time, some of them might be too gassy or might have too many liquids and not enough oil, and they just can't stand on their own. So you've seen some DUCs really come off in the Eagle Ford and Bakken, but the Permian remains relatively flat, and that's where we think we're going to see we're going to start to see an increase in frac spreads over the next, call it 6 weeks, as some Permian production comes back. And it's really because exports remain relatively elevated compared to where we thought it was going to be. And we'll talk about why in a minute. But here you kind of have where some of that activity can really kind of come back, where the Bakken and Eagle Ford we think are going to remain relatively stable as we're thinking about completion crews. So when we think about realized prices, you can see the LLS, which is Louisiana Light Sweet, and Magellan East Houston, they're over $41. And right now Brent is at about $42.85. So you're about $1.50 off what's happening in the global market. And when you think about Urals and West Africa, some of these crude blends are trading $3 above dated Brent. So this really does help pull more U.S. crude into the market through exports. And where's the geographically best place to be? Texas at this point. And that's why we think we're going to start to see a little bit of an increase. And again, even though we're only refining at a 75% utilization rate, that's still almost 14 million barrels a day of throughput, with about 7 million happening in Pad 3 of the Gulf of Mexico alone. So there is a certain amount of benefit to being in these areas, which is why we think we're going to start to see a little bit of activity start to adjust. Initially, it's still going to be shut-ins. ConocoPhillips has talked about 100,000 again from Alaska in July, and they're going to make month-to-month decisions on some of the shut-ins, which we think at this pricing deck, you're going to see some of their Permian wells come back online. But the pain still remains, and the pain still you can see with some of the bankruptcies that have already happened in 2020, and it's the fastest pace since 2016. But again, the environment is very different in 2020. We have balance sheets are worse. We have acreage evaluations going the wrong way. So we continue to think there's going to be consolidation in the market, and you're just going to start to see things, tighten up. And these mergers will help and kind of give a little bit of a stronger market that can be a little bit more insulated to some of these price moves, just because they're going to have more of economies of scale, and they're just going to have better balance sheets coming out the other side of this. But again, there's still a lot of pain ahead of us. Now, next week we're gonna release an NGL report. And we've talked about really kind of going a little bit deeper into the chemical space, because we talk so much about refining, but chemicals is also a buyer of naphtha, condensate, NGLs or natural gas liquids, but also, to a smaller extent, oil. And here you can kind of see why we talk about some of these margins. So the economy continues to struggle. We're going to be down on a global level, which is going to impact the demand for plastics, LLDPE, which is low density polyethylene. Then we're going to have high density polyethylene, which is kind of the bellwethers that we use. But ethylene is a huge component because we have a huge surge in capacity. So not only are we going to have a demand problem, but we also are facing a steep oversupply. And this is where you can see the capacity increases that are coming online in 2019, 2020, 2021. Obviously, in the current environment, we're going to see 2021 try to get delayed. But again, 19 has already come on, and 20 is also going to continue to come on, because at this point, you either turn it on or you're going to have to realize a loss, and they'd rather turn it on, keep it at a lower utilization rate, and try to lose less money, or at least cover some of these fixed or variable costs given whatever they can get in the market. And this is something that we're going to talk on in a bit more detail next week, but we also have to consider, where spot prices are in Houston. Now, I can pull up any chart. It can be South Korea, Japan, China, Europe. They all look very similar in terms of just the pressure which again started in 2018. And the pressure really started to kick off because of the overcapacity and the slowing demand that we saw coming into 2019, which is where we showed you PMIs and a lot of the economic data getting worse in 2019. And now here we are, and we're kind of flatlining in this 2020 level just because you have utilizations coming off, you have feedstock prices coming down. So there's a little bit more margin, but again, the overcapacity is going to remain in the market. And this is going to be something that's going to weigh on pricing and will hurt utilization rates, as we go through the end of the year and well into 2021. So thanks again for watching. Next week we can look forward to our EIA report. We're going to go through chemicals in a bit more detail. We're going to have our natural gas report coming out, and then obviously we're going to cover everyone's favorite topic, the primary vision frac spread count. So thanks again for watching. Have a great 4th of July. Again, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Thanks again.